there's a dangerous game that central banks play here if they start to back off from their inflation fight, because the last thing they want to see is inflation accelerate, which is what the lesson of the 70s were when just when central banks thought they had corralled inflation, backed off from that fight, inflation reaccelerated. And I do think that Jay Powell has that fear, and why he will only cut gingerly if he does start to cut.
Peter Boockvar, Chief Investment Officer at Bleakley Financial Group and a CNBC contributor. It is so great to welcome you back on the show, and great to see you again, Peter. Thank you so much for taking the time to join me.
Of course, Julia. Thanks for having me back on.
Well, I'm really excited to have you, especially as we have grown the channel. And so there are a lot of folks, I'm sure that they watch CNBC and they see you there as a contributor, but I'm excited for them to get to hear from you for the first time if they're new to the channel. And I'd like to start where I always start with my guests, Peter, and that is to get your big picture, macro view, where we are today. What is that framework in which you're looking at the world? And one of the things about this show, Peter, is you can take all the time you need to set the table when it comes to that macro picture.
All right. So in the 30-ish years that I've been in this business, this is the most mixed and uneven economy that I've seen. For every plus, there's a minus. And even within specific areas of the economy. You take housing, for example, you have the pace of existing home sales that are trending near 30-year lows, but new builds are doing better. Not great, but doing better because the market needs more inventory. And then even within the home building business, you have bigger builders that are taking market share and doing better than smaller builders, also because they have the ability to discount their product through either mortgage buy downs or other incentives. Take the consumer itself. You have the higher income consumer that's feeling better about their state rather than lower to middle income consumers, because inflation affects them less than the lower income consumer. The lower income and even middle income consumer are focusing more of their spend on their needs, less so on their wants. They're focusing more on service/experiences and travel and restaurants and eating out rather than on stuff. So there's a mixed bag there. If you look at the manufacturing sector, well, it's been in a recession for about 2 years now. There's the hope that maybe this inventory destocking and the shift away from spending on goods has run its course. Maybe we'll get a period of inventory restock, but not seeing that just yet. We know an enormous amount of government spending has helped to boost economic activity on one side, where budget deficits of 6% of GDP is itself a natural lift to economic activity, particularly where the money's going. It's going into healthcare via Medicare, Medicaid. It's going to boomers and older retirees via Social Security payments. It's going to the defense sector, and it's going to those that hold U.S. Treasuries via interest income. So that flows into the broader economy. And then you also have the government-induced spending on manufacturing facilities to make chips and EV batteries and so on. But even that money, we'll have to see what the payoff is of that, because there's one thing to build a facility. There's another thing to actually make a product at an affordable price that you can then sell. So you combine all this together, and to me, it feels more like a 1.5% type GDP growth rate economy rather than something that's around 3%. And then I'll layer in a lot of the company conference calls that I listen to. And if I had $1 for every time I've heard challenging macro environment, and not just the quarter that ended for Q1, but all of last year, I heard that too. Now, what that means for inflation and the Fed, it definitely creates a conundrum, because the Fed can lean on the softness in encouraging them to cut, but then they can highlight the strength. One last thing I wanted to add on the economy is the labor market. Labor market itself is very mixed. You have an unemployment rate of 4%. On one hand, it's historically very low, but on the other, it's the highest since January 2022. And if you look at the trajectory of the unemployment rate, it's definitely ticking higher. If you look at the JOLTS data, if you look at initial claims and continuing claims, if you look at plans to hire within the NFIB survey, if you listen to what ZipRecruiter has to say and their earnings over the last bunch of quarters, the demand for labor is shrinking. The pace of firings, on the other hand, notwithstanding the last couple of weeks of a tick up in jobless claims, still remains somewhat muted. So even within the labor market, there are a lot of mixed signals. So overall, it's a confusing environment to try to figure out.
Wow. A great frame up to the conversation too. That's something that I'm hearing from many guests is it's confusing especially when you look at the data, you can extrapolate very different narratives, bifurcation happening in the economy. When you kind of step back and look at all of that, it sounds like when you say it feels like more of a 1.5% growth rate versus a 3%, what about the go forward? And maybe more of your outlook there. I guess it can go one of two ways, right? Or maybe three. You could stay mixed, or we could come out of this and kickstart some growth, or maybe it goes the other way.
So layering on top of that is what's going to happen in the rest of the world. Since U.S. GDP is only about 20% of global GDP, you have European economies that are mixed. Manufacturing in Germany and France and other parts of the region are challenged, but the tourism industry in Italy and Spain and Greece, Portugal seem to be doing great. So a mixed bag there. Look at Asia. You have India growing 7 to 8%, but China's growth rate dramatically slowing down. You have Japan, which is showing signs of hopes, but little GDP growth. Southeast Asia is doing better. I think putting this all together about what happens from here, I think that U.S. growth is more likely to slow from this 1.5% pace rather than accelerate. And a lot of it has to do with this continued digestion that I think that needs to take place in terms of our economy adjusting to this higher rate environment. And the higher rate environment is actually helping some parts of the economy, like those on fixed income, where they can actually get some interest income. And you see that in the cruise line numbers, for example, because that's where they're spending their money on. But on the other hand, I think that the higher interest rate environment, which historically speaking, rates are not that abnormal. What is abnormal is that it comes after 15 years of zero, that there's still a lot of debt that comes due in the coming years, that businesses via debt maturities, households via ARMs, adjustable rate mortgages that are maturing, that need to reprice. If you're in commercial real estate, you know the pain that you're dealing with if your debt is coming due this year, where the rate on that loan was probably priced before 2022 at a rate nearer 3% rather than the 8% now on offer. So there's still this period of time of debt maturities that I still think that we need to chew through. That's going to be painful for anybody that has debt coming due. The world needs more equity. It needs less debt, but that is a long-term process, a multi-year process for us to work through. And also you're still dealing with the cumulative impact of higher inflation. I don't discount the possibility of inflation inflecting up again, particularly on the goods side, which could cause some pain. We've seen container shipping prices that are literally skyrocketing again, which is leading to higher air cargo costs that will then soon filter into higher manufacturing costs. And if manufacturing globally is bottoming out, then we're going to start to see an inventory restock again. You could see prices there rising again. So it's a really, like we said earlier, a confusing picture. And I think it's so confusing for the Fed as well. And why they will likely cut by the end of this year. It's not just going to be a typical rate cutting cycle where they're just going to slash and burn in response to a slower economy like they have in the past, because I think inflation, even though it's moderated, very much ties their hands in their ability to react to challenges.
Yeah, I want to explore that a bit further too. You mentioned the Fed likely to cut once this year. Okay, let's explore like that scenario. What kind of difference would that even make? Like just a single, 25 basis cut. Would that have an impact? Just curious how you're thinking about the Fed and the potential for a rate cut.
Well, I'll say zero. It'll have zero impact on the economy. And I'll even argue that if the markets start to believe that this is the beginning, it's not just one, it's actually going to be a progression of cuts because the unemployment rate continues higher. If the long end of the bond market starts to worry that the Fed has shifted their focus to employment from inflation, you could see a couple things. You can see weakness in the dollar, which can then regenerate import inflation and higher commodity prices, particularly higher oil prices. The long end of the curve may say, why am I buying the 10-year here at 4.25 if the Fed is now getting cute and cutting interest rates on the short end? And you may see a situation where the yield curve steepens in a bear steepening way where short-term interest rates fall, but long-term interest rates rise. So Fed cuts here are a much difficult maneuver and threading of the needle than the Fed has had in the past. So it's a much more complicated situation here if the Fed does go down that path.
Yeah. All right. So for like a lay person like myself, can you kind of just explain a bit of this bear steepener, the dynamics? And I believe you have a background in fixed income as well. Like how would one navigate that situation and maybe extrapolate some of the other implications of that?
So that would be a bear steepener as opposed to a bull steepener. A bull steepener is where short-term interest rates fall more than long-term interest rates. So the yield curve steepens, but it's where the short end of the curve does most of the work on the downside. A bear steepener is where the yield curve would curve upward, but it would be because long-term interest rates rise more than short-term interest rates may fall. So that's sort of the scenario that you don't necessarily want to see, because it would be the market telling you that we're worried about inflation not being won yet, and you're sort of giving up on it. And also we have to throw on the possibility that U.S. Debts and deficits are just overwhelming the market in terms of supply, that long-term interest rates rise for the wrong reason, that wrong reason being the inability to absorb all that supply. And then maybe the wrong reason being the dollar weakens, and that leads to a rise in long-term interest rates. Very emerging market type-esque action where you get currency weakness and higher interest rates. So those are the things that we have to watch out for. This is not going to be an easing cycle like we've seen in the past, where the Fed has had carte blanche to do whatever they want with their experimental central bank behavior. Not just the Fed, I'm talking about other central banks too. I mean, look at the ECB. They cut as they wanted to, but they made it a point that this is not just going to be a progression of more cuts, because there's a dangerous game that central banks play here if they start to back off from their inflation fight, because the last thing they want to see is inflation accelerate, which is what the lesson of the 70s were when central banks thought they had corralled inflation, backed off from that fight, inflation reaccelerated. And I do think that Jay Powell has that fear, and why he will only cut gingerly if he does start to cut.
Yeah. Okay. So when I was just listening to you earlier, you pointed out like the zero interest rates, that was definitely not a normal environment. And what I'm kind of gathering here is, don't get used to what you were normally used to. Like, it sounds like maybe higher inflation, higher rates, and even if they cut rates, it's not going to be like the normal cycle. I would love to just kind of hear, like, from your vantage point, what does kind of the new normal look like, if you will? What are the things that folks need to be thinking about versus like how things had been? How do they need to rethink that framework?
So let's start with inflation, since that will flow through into where interest rates go and what the Fed does. I acknowledge inflation is definitely moderating. It's been moderating since the peak in the summer of 2022. The question is where does it settle out at? Are we just going to magically go to 2% on inflation and just stay there? Is it that sort of easy post this inflationary spike that we had and now fallback? I don't think that magically happens, because there's one thing to have inflation spike, have it come down, and then have it stay down in a sustainable way. And I think that we're going to have, on a sustainable basis, now back half of this year, we can have inflation in the twos for a period of time, and everyone's going to declare victory, and the Fed's going to think their job is won. But I don't necessarily think that we stay there. I think 3 to 4% is a more sustainable, unfortunately speaking, inflation rate, where Goods prices, which in the 20 years leading into COVID averaged zero, give or take up and down, but it averaged zero. Technology is a disinflationary force, but it's been that way since the history of mankind. But you do have some offsetting things here, like all that government spending, the shifting around of supply chains around the world, higher labor costs in manufacturing that maybe can be offset by automation, but maybe not so fast. And that instead of being zero, goods prices may be 1% to 2%. And services inflation, which was never transitory. And in the 20 years leading into COVID, core services prices averaged 2.8%. And maybe instead of 2.8%, it averages 4% instead, because we have higher labor costs that are, even though they've plateaued, are still running well above where they were pre-COVID. You have all these initiatives on the part of state and local governments to push wage increases and other regulatory burdens on businesses that they have no choice but to raise prices. So now if I'm right and 3% is the new normal instead of 1% to 2% that we got used to pre-COVID, then that means that interest rates are that the higher for longer mantra is not just an overused cliche, it's for real. And that means that the cost of capital is going to stay more elevated. Now, over time, maybe that's a good thing that we can have normal interest rates, but a 9% borrowing rate for a small business is tough. It's tough to manage. And, I mentioned earlier that the world needs more equity. Businesses may need more equity rather than debt if they're going to finance itself. And that's a higher cost of capital, too. That's not so easy to find. And we also have to think about what economic activity is not taking place because of this higher rate environment. What building is not being built because of 9% interest rates? What business is not getting formed because they can't raise the money to do that? What house is not being bought by a first-time buyer because they can't afford the 45% rise in home prices on top of a 7% mortgage rate, which forces them to rent longer? So it's that stuff that doesn't happen because of rates of where they are. You look at multifamily, and I think this is important to focus on, because multifamily and higher rents was a main factor in higher inflation. But then, because of easy money pre-2022, you had all this apartment building that was greenlit that is now coming onto the market this year. So rent growth is now slowing dramatically. New rents are flatlining. Renewal leases are up maybe 3%. That will eventually flow into CPI. But because of the environment we're in now, of the higher cost of money and rental prices slowing, there's been a dramatic drop in multifamily construction, which means that in the back half of 2025 into 2026, rental prices are going straight back up again. And could happen in a notable way, because a lot of people can't afford to buy a home and they're renting. And a lot of the supply this year is going to get easily absorbed. So any relief we're getting on the rent side and the services side of inflation in the back half of this year, to me, is only going to be temporary.
Yeah, such a good point. And I can tell you, I feel that, because I'm like one of those people that it's cheaper for me to rent right now versus buy. And I got to say, I would like to buy. It's just I'm not so sure about the time. And when we opened this conversation, the first thing you brought up in the macro picture was housing. Can we just hear more of your views there? Just more of your outlook on the housing market. I know it's a critical part of the economy, but maybe you have some good news for someone like myself in the future. Who knows?
So it sucks for the first-time home buyer, because they're not playing with house money, so to speak. Whereas someone who owns a home has benefited from the appreciation. So if they had to absorb a 7% mortgage rate on a new home from the 3% they have now, that would be tough, but they at least have the benefit of appreciation in their home, even though they may be paying more for their new home. So not necessarily helpful to them, but it's worse for the first-time buyer that is paying that 7% mortgage on top of a 45% plus rise in the average home price since the Fed went back to zero interest rates in QE. The positive for the buyer now, though, is that more homes are being listed. Life still happens. People still need to move. What I think needs to happen in the housing market is, yes, we need new construction, but we also need baby boomers to downsize. We need to have them sell their house that they've been in for 30 plus years and have them move into a new townhouse community because their kids are out of the house, and allow first-time home buyers to buy their house. We need that extra supply. But I think right now, home price acceleration is making it tough. And you have to also think about that for every housing transaction that does not take place, because when you think about that person buying a house or that family buying a house from a seller, the person buying that house, an existing home, well, if they're not making that purchase, they're not renovating the house, they're not painting the walls the colors that they want, they're not putting down the flooring that they want or adding carpet, they're not adding the touches that they want, they may not be buying new furniture, and the seller who is moving into someplace else is not doing that either. So there's a lot of things that don't happen when you don't get the turnover of an existing home. So and the Fed has turned the housing market upside down, and they did this beginning in the mid 2000s when Greenspan cut rates to 1%, which was the genesis for the housing bubble. It's totally upside down, unfortunately.
Yeah, such a good point. Another area I'd like to explore with you, you mentioned that we need more equity than we need debt. And I just want to zoom out. Let's just talk about the debt situation. Let's just talk about the debt situation here in the US. Last I checked, it was north of 34.6, maybe 34.7 trillion. I haven't looked at the debt clock lately, but just continue to grow. Deficit. I know people talk about it. At some point, it's going to be a problem. When will it be a problem, or is it already a problem? Just curious, like your thoughts on the debt situation.
So in the 1980s, people were whining about the rising U.S. debts and deficits. And people were calling for ever-rising interest rates because of the crowding out that the government was taking over in terms of capital, and the dollar was going to tank, and so on and so on. And here we are 40 years later, and we asked the question that you just asked, when will it matter? And the reason why I think now it matters is because I think a bond bear market started. Well, the bond bull market bubble peaked when we had $18 trillion of negative yielding securities, driven by the genius, I say very sarcastically, of the central bankers who thought that negative interest rates, nominal negative interest rates, was a good idea, which I refer to as the dumbest idea in the history of economics and monetary policy. So here we are, the backside of that, where fortunately we don't have any negative yielding securities anymore, with Japan being the last holdout. And I do think, though, and I think this in this new higher rate environment that countries can't get away with rising debts and deficits like they once were. And we sort of got a taste of that with the Bank of England last year, with this liability-driven investment that caused a panic with pension funds and the spike in gilt yields that the Bank of England had to step in. We got a taste of it the last couple of weeks with worries about the French parliamentary elections next week and what that can mean. So it seems that the market is more sensitive to fiscal recklessness, and this time may be different than what we've seen over the last 40 years, and that, yes, maybe we are in a bond bear market, and that ever higher interest rates could be upon us. Now, we haven't seen really the effect yet. The Treasury is still selling the debt that they need to raise at these auctions. Now, granted, a lot of the auctions over the past 6 to 12 months have been pretty mediocre at best, with the occasional good ones, but mostly mediocre to poor ones. But you just wonder, when is that failed auction going to take place? When's that bid to cover going to be less than one? And I can't discount that possibility, because the problem right now with the budget deficit and the money that the government needs to borrow, as seen by the CBO, which raised its budget deficit estimate by $400 billion for the U.S. Treasury to near $2 trillion, is that higher interest expense and the non-discretionary spend that is on autopilot, that this just continues to compound. and gets worse and worse. And you also wonder about this sort of bipolar economy and geopolitical world that we're sort of creating with China on one side, the U.S. on the other, and countries wanting to use dollars less to transact in critical minerals and oil and other commodities. So all these things come together, and I do think that this now matters. Now, in terms of Congress and the president actually doing something about it, to me, a 6% 10-year will cause a crisis and a panic in Washington that maybe would be the trigger for them to respond in some way to the excessive and reckless spending that we're seeing on both sides of the aisle.
Yeah, a 6% on the 10-year. Okay, let's explore that scenario. What would that mean for other markets as well? Because I imagine if there's 6% on the 10-year, wouldn't people move into the 10-year and out of stocks if they could get that? I mean, I don't know. So I want to hear from you, like, what are some of the other implications of that kind of scenario?
Well, I talked about earlier just the maturity wall of digestion that we have to work through over the next couple of years in terms of lower cost debt repricing at higher interest rates. Imagine if those interest rates that they need to refinance into is even higher than it is today. That will be extraordinarily painful. If we do think that 21, 22 times PE ratio for the S&P 500 is expensive, it'll feel even more expensive with a 6% 10-year rather than one that's closer to 4.25%. So there could be a lot of pain involved in that. And then it also ties into where the stock market goes, because we talk about the economy, but we sometimes forget to understand how influential stock prices are to the economy. And I talked earlier about the higher income consumer that's doing better, the baby boomer that's doing better. Well, I will argue that they would not be doing better if the S&P 500 was at 3,000 instead of 5,500. It would be a much different consumer type behavior. So where the stock market goes in response to where interest rates go, where earnings grow, where the economy goes, is itself a driver of where the economy is going to go, at least a part of the economy for those people that own stocks, because these baby boomers, they're still heavily involved in the stock market. So while they may be benefiting on some of their savings, getting 5% interest income, a drop in the stock market would be painful offset to that if it were to occur.
Yeah. Although I imagine it could be an opportunity for some. It would be painful for many, but okay. We're talking about the economy. We brought up markets. I want to hear more on the markets today, just kind of your assessment, and then maybe we can get into like some ideas or how you're thinking about playing the CMR, maybe more of like what you like these days.
Well, just as I described sort of a two-lane economic highway, it seems that way with the stock market as well. With the S&P 500 up, call it 14, 15%, the equal weight up maybe 4 to 5%, small caps underperforming large caps. And it's not just, oh, I like NVIDIA, I'm not going to own anything else. There are parts of the economy that are challenged right now. And I think, and not just domestically, but internationally. And I think there are a bunch of stocks that reflect that. So you have the AI stock market, you have other parts of the market that are doing okay, and then others that are doing really poorly. And I think the valuations that we're seeing in NVIDIA and some of these other names are so off the charts. And when I define off the charts, I'm talking 20, 30 times sales is to me off the charts and unsustainable. There's a lot of danger in these stocks. And I know it feels good and there's AI sexy excitement here, but I think people need to do a serious self-reflection of what sort of benefits we're going to get from the area of the market that people are piling into the most. Now, that can be a whole AI conversation that we can get into, but in terms of what I like, remain very bullish on, and I say remain because we have been for the last couple of years, full disclosure on energy stocks, precious metals, recently got into an agriculture position via fertilizers, Mosaic and Nutrien that we were in going into the Russian invasion of Ukraine. Freeport as a copper play. So I think there's a bull market here in commodities, and we like a bunch of stocks in that space, and we've been bullish on long uranium for a while. There are cheap stocks out there that the one thing you need to have when you're buying a cheap stock is time horizon. But there's a lot of value out there that I think consumers need to dig deeper to find, particularly in smaller to mid-cap names. And I just think that people should just be careful getting tempted by the allure of this AI sexiness, because AI has been around for 75 years. It's not new. And I think people need to understand that this phase that we're currently in is going to be difficult to sustain in terms of multiple expansion and growth rates for the NVIDIA and other chip names, and that there are other parts of the market that exist. And I'm also very bullish on Asia. I look out over the next 10 years and I ask myself, where is the economic growth going to come from? And to me, all signs point to Asia in terms of growth rates. And it is the rising middle class. It is the rising middle class in China. Say what you want about China, but that middle class is going to double over the next 10 years. Look at the middle class that we're going to see in India, in Indonesia, and Vietnam. This is half the world's population. So businesses that cater to that rising middle class in Asia, whether you're domiciled in countries there, or you're a U.S. company that's going to do business there, or a European company that has big trade in Asia, that is where I'm looking. That's where we're long. And that's where I'm most excited about from an investing standpoint.
And does that also tie back into the commodities thesis as well, like with the allocation there because of this like rising middle class in Asia?
Yes. So for every U.S. investor that wants to sell their oil and gas stock because they think everyone's going to drive EVs and no one's going to put gasoline in their car anymore, go to India, go to other parts of the world where they can't afford a $50,000 Tesla, where they have no choice but to buy lower cost internal combustion engines. Now, China is dominating right now in low cost EVs. That's going to be a big plus. But petroleum products go into a lot of things in addition to cars. So the demand for fossil fuels, to me, at least for the next 10 years, is going to be a pretty linear line upwards, notwithstanding any dramatic global recession we could have.
Yeah, makes sense. I've got to say, I've really enjoyed having you back on, Peter. I've taken so many notes in this conversation. Before I let you go, I want to give you the final few minutes here to share more about, let's do a couple things. Let folks know where they can find you and your work. I know you have a Substack, the Book Report. Maybe you can let them know about Bleakley Financial Group, and let's leave the audience with some parting thoughts. You've been in this business for over 30 years. Just, something to think about before we let you go.
So as you said, I write daily on the macro and the micro via my Substack page, and people can test it out. And I try to focus as succinctly as possible on things that I find relevant. And then Bleakley Financial Group is a wealth management firm. If anybody has interest, they can go to bleakley.com to learn about us. And parting words here is the investment world is never easy. And whenever it feels that way, something's about to change. And I don't want to downplay the excitement of AI, but keep in mind that software and technology have been a main driver of human advancement forever. And every new iPhone is a better iteration on the one before. Every new technology, every new piece of software is a better iteration on the one before. And generative AI is going to be very helpful, but it's a tool. It's a tool like any other piece of technology. And I just think that people should just have proper perspective on things. And also, the investment world is big. And don't just confine yourself to a few stocks in the U.S. Use a wide lens. Because I think if you do, you'll capture even more potential investment opportunities.
I love it. Well, Peter Boockvar, Chief Investment Officer of Bleakley Financial Group, author of the Book Report, CNBC contributor. So great to have you back on the show. We really appreciate you taking the time. Thank you so much, Peter.
Thanks. I appreciate being asked on, and it was great to chat with you.